Picture this. January 29th, 2026. Silver punches through $120 an ounce for the first time in human history. Champagne corks are popping on FinTwit. YouTube gurus are screaming, "I told you so." TikTok stackers are filming their vaults. And then, in the space of a few brutal hours, the entire thing collapses. $10. Gone. Evaporated. $111. Panic. Liquidations. Margin calls eating traders alive. But here's the twist nobody's talking about. While retail was puking their positions into the void, someone else was quietly scooping up millions of ounces. So was this a crash? Or was this a transfer? Was silver broken? Or were the people holding it just too weak? Because what happened wasn't random. It was mechanical. It was predictable. And it's setting up the next move right now. Stick around, because by the end of this, you're going to understand exactly why this violence happened, who got destroyed, who's positioning for what comes next, and whether you're about to miss the opportunity or walk straight into a trap. Part 1. Before the fall. The coiled spring everyone misread. Let's rewind. Before silver face planted $10 in a single session, it was doing something most people completely misread. It wasn't rallying in a straight line. It wasn't crashing. It was coiling. And if you don't understand what that means, you're going to get wrecked every single time. Silver had been consolidating after an absolute monster run. We're talking about a 65% gain in January alone. 65%. In 1 month. That's not normal. That's not healthy. That's the kind of move that separates disciplined traders from emotional tourists who think markets only go up. The metal had ripped higher on a cocktail of fears. Monetary debasement, industrial demand surging from the green energy transition, and geopolitical chaos that had people rotating into hard assets. But then it stopped. It didn't collapse. It just stopped. And that sideways chop, that's what we call coiling. Here's the thing about silver that makes it so dangerous and so compelling at the same time. It's got a split personality. It's part monetary metal like gold. When the Fed pivots, when real yields drop, when the dollar weakens, silver catches a bid as a leveraged inflation hedge. But it's also an industrial metal. It's in your solar panels, your electric vehicles, your 5G infrastructure, your AI hardware. Every time a government announces another green energy package, they're indirectly announcing bullish news for silver. So silver sits at this weird intersection where monetary policy, industrial demand, and speculative mania all collide. And that makes it inherently more volatile than gold. Gold is the stable older sibling. Silver is the younger brother who either makes you rich or puts you in the hospital. The volatility is not a bug, it's a feature. And if you don't respect that, the market will teach you the hard way. Now, before the crash, the setup was fascinating. You had this tense consolidation after those earlier bursts of strength. The metal was holding up better than most people expected, especially given all the noise around interest rates and recession fears. There was no euphoric breakout, but there was also no meltdown. Just this grinding, frustrating sideways action that was driving short-term traders insane. But here's what the smart money understood. Prolonged sideways action in a structurally tight market is not boredom. It's compression. It's energy building. It's the calm before something violent happens. Let's talk structure. Silver's supply side is a mess. New mine supply is limited. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. You can't just flip a switch and produce more silver when prices rise. It takes years to develop new projects. Costs are rising, and ESG pressure is making it harder to open new mines. Meanwhile, demand is sticky and rising. Solar installations are exploding worldwide. Every solar panel needs silver. Electric vehicles need silver. 5G build-out needs silver. AI data centers need silver. This is not speculative. This is structural. So you've got constrained supply meeting rising demand, which creates what the long-term bulls call an industrial supercycle. But in the short term, none of that matters if you're over-leveraged and a margin call hits. And that's exactly what separated the survivors from the casualties on January 29th. The psychology before the crash was textbook. You had two camps. The tourists, people who jumped in after watching a YouTube video about silver squeezes, who didn't understand volatility, who were trading with leverage they couldn't afford. And then you had the serious traders, the ones who understood that silver is a battlefield, not a savings account. The tourists saw the consolidation and got impatient. The serious traders saw the consolidation and prepared for the next explosion. But nobody, and I mean nobody, was prepared for what happened next. Part 2. The Smash. Anatomy of a $10 intraday collapse. January 29th, 2026. Silver hits an all-time high near 120.50. It's a historic moment. Decades of waiting. Stackers are celebrating. The Reddit forums are going ballistic. And then the floor drops out. In a matter of hours, silver collapses over $10, 111. The move is so violent, so sudden, that trading platforms start glitching. Social media floods with disbelief. Margin calls are firing like machine guns. Accounts are getting liquidated in real time. And the worst part? Most people still don't understand why it happened. Let's dissect this thing mechanically, because this wasn't random. There were 3 documented catalysts, and they all hit at once like a perfect storm designed to punish weak hands. Catalyst number 1, the tech stock crash and liquidity contagion. Microsoft and Oracle, 2 absolute juggernauts of the AI trade, got absolutely demolished. The tech sector puked, and when tech pukes, everything else bleeds. Why? Because when traders are sitting on massive losses in their equity positions, they don't get to choose what they sell. Their brokers choose for them. Margin calls force liquidation across all asset classes. So even if you're bullish on silver, even if you believe in the long-term story, if your tech stocks are imploding and your broker is calling, you're selling your silver. You have no choice. This is cross-asset contagion, and it's one of the most underappreciated dynamics in modern markets. Catalyst number 2, CME margin requirement hikes. The Chicago Mercantile Exchange, which is where silver futures are traded, raised initial margin requirements to approximately $25,000 per contract. Let that sink in. If you were trading silver futures on leverage, you just got hit with a massive capital requirement increase, and if you didn't have the cash to meet that new requirement, your position got liquidated. Automatically, no mercy. This is how exchanges manage risk, but it's also how they create cascading sell-offs. One forced seller triggers stop losses, which triggers more forced sellers, which triggers more stop losses. It's a liquidity vacuum and it's brutal. Catalyst number 3, institutional profit-taking. Silver had ripped 65% in January, 65% in 1 month. If you're a large institution, if you're an ETF manager, if you're sitting on those gains, you're going to take profits. And they did. Nearly 29 million ounces were sold by ETFs since the start of the year. That's not conspiracy. That's not manipulation. That's just profit-taking after a historic run. But when institutions sell, they don't tiptoe. They unload size, and that size hits the market like a freight train. Now here's what makes this even worse. Futures markets amplify moves in a way that physical markets don't. If you're buying physical silver bars and storing them in a vault, you're not using leverage. You can't get margin called. You can hold through volatility, but if you're trading futures, you're using leverage, and leverage is a double-edged sword. On the way up, it multiplies your gains. On the way down, it multiplies your pain. And on January 29th, it multiplied a lot of pain. This is what we call a flash crash. It's not that silver became worthless. It's not that the fundamentals changed. It's that liquidity disappeared. When everyone wants to sell at the same time and there are no buyers, prices gap down violently until they find a level where buyers finally step in. That level was around $111. And the people who survived, they were the ones who either weren't leveraged or who had the capital and conviction to buy into the panic. This wasn't the end of silver's story. It was a stress test, and most people failed. Part 3. Panic Mechanics. How retail capitulates first. Let's talk about who got destroyed, because understanding who loses in these situations is just as important as understanding what happened. The first casualties were the over-leveraged CFD traders. Contracts for difference, CFDs, are one of the most dangerous instruments retail traders touch. You can trade with 50-to-1, 100-to-1 leverage. Sounds great when you're winning. Sounds like a death sentence when the market moves against you. And on January 29th, it moved hard. If you were long silver on high leverage, you got wiped out before you even knew what hit you. No second chances, no time to react, just liquidation and a zero balance. The second group that got crushed were the short-term momentum chasers. These are the people who bought silver at 115, 118 because it was making new highs and they didn't want to miss out. FOMO is one of the most expensive emotions in trading. They didn't have a plan. They didn't have a stop loss. They just saw green candles and jumped in. And when those green candles turned red, they panicked. Panic selling at 112, 110, watching their accounts bleed out in real time. The emotional cascade is textbook. First, there's euphoria. Silver's at all-time highs. Everyone's a genius. Then disbelief. Wait, why is it dropping? This doesn't make sense. Then fear. Oh no, it's still dropping, then forced liquidation. The broker makes the decision for you, and by the time the dust settles, you're sitting there wondering what the hell just happened. But here's where it gets even more insidious. Social media amplification. YouTube creators had been pumping out breakout videos. Silver to 150. The squeeze is happening. TikTok was full of people unboxing their silver bars, flexing their stacks, talking about escaping fiat currency. Instagram was loaded with motivational posts about stacking physical and getting rich. And all of that content created a feedback loop of optimism that wasn't grounded in risk management. When silver crashed, those same platforms turned into echo chambers of frustration, confusion, and conspiracy theories. The market is rigged. The big banks are manipulating silver. We're being cheated. And look, I get it. When you lose money, it feels personal, it feels unfair, but the reality is simpler and harsher. The market doesn't care about your feelings. The market cares about supply, demand, leverage, and liquidity. And on January 29th, the structure punished the unprepared. This is why silver feels manipulated to retail traders. It's not that there's a shadowy cabal pulling strings. It's that the structure of the market, futures, leverage, margin requirements, institutional size, creates dynamics that retail doesn't control and often doesn't understand. When you're trading against algorithms, against institutions with billion-dollar balance sheets, against market makers who can see your stop losses, you're not competing on a level playing field, and pretending otherwise is financial suicide. Let's talk about the humanitarian angle here, because this isn't just about charts and contracts. Real people lost real money. Small traders who were trying to protect their savings, who believed in the silver story, who got caught in a system designed to transfer wealth from weak hands to strong balance sheets. Margin rules they didn't fully understand, volatility they couldn't stomach, and the psychological damage of getting whipsawed, watching silver rip higher, buying in, then watching it collapse, that sticks with you. It makes you hesitant, it makes you second guess, it makes you quit right before the next real move happens. The hard truth is this: volatility doesn't transfer wealth randomly. It transfers wealth from the emotional to the disciplined, from the over-leveraged to the patient, from the reactive to the strategic. And January 29th was a masterclass in that transfer. Part 4. Smart money doesn't panic, it waits. So while retail was getting obliterated, what was smart money doing? They were buying, quietly, methodically, without emotion. Let's define smart money, because it's not some mystical force. Smart money is institutions, industrial buyers, sovereign actors, entities with deep balance sheets, long-time horizons, and the ability to withstand short-term volatility. They don't trade on feelings, they trade on structure. And the structure right now is screaming opportunity. Here's the evidence-based accumulation logic. First, there's a structural supply deficit of approximately 30 million ounces. That's not a projection. That's documented. Demand is outstripping supply, and that gap is widening. Industrial offtake from solar, EVs, and electronics isn't slowing down. If anything, it's accelerating. Every net zero policy announcement, every renewable energy target, every AI data center build-out, it all requires silver, and the supply side can't keep up. Second, China just dropped a geopolitical bomb that most people aren't paying attention to. Effective January 1st, 2026, China implemented strict export restrictions on refined silver. They're limiting exports to protect their own domestic solar and EV infrastructure. Think about what that means. China has been one of the largest suppliers of refined silver to global markets, and now they're cutting off that supply artery. This isn't temporary. This is strategic. They're cornering their own supply for their own industrial needs, which means everyone else has to scramble for the remaining global supply. That's a structural tightening that doesn't show up in price overnight, but it absolutely shows up over the next year, 2 years, 5 years. Third, the monetary backdrop is shifting. The Fed is no longer aggressively hiking rates. Inflation isn't dead, but it's not run away either. Real yields are softening, and in that environment, silver acts as a leveraged monetary hedge. When the dollar weakens, when real yields drop, silver outperforms gold on a percentage basis. It's more volatile, yes, but it's also more explosive to the upside when the macro winds shift in its favor. Now, let's be clear. Calling this a generational entry point is probabilistic, not guaranteed. Nobody has a crystal ball, markets don't move in straight lines. But the risk-reward setup right now, buying silver after a $10 intraday crash, with a structural supply deficit, with China tightening exports, with industrial demand growing, with the Fed pivoting, that's the kind of setup that serious money pays attention to. The narrative is simple. Price fell, but value didn't. The fundamentals didn't change on January 29th. The supply deficit didn't disappear. China's export restrictions didn't get reversed. Industrial demand didn't collapse. What changed was sentiment. What changed was leverage. What changed was who was holding the metal. And that's exactly the kind of environment where smart money accumulates while everyone else is running for the exits. Here's the kicker. Smart money doesn't announce what they're doing. They don't go on CNBC and say, hey, we're loading up on silver here. They just do it. Quietly, in size, over time, and by the time retail figures out what happened, the price is already gone. So the question isn't whether smart money is buying. The question is whether you're positioned to benefit from what happens next, or whether you're still licking your wounds from what just happened. Part 5. The zones that decide everything. Let's get tactical, because if you're going to survive and thrive in a market this violent, you need to think in terms of zones, not single prices. Institutions don't trade off hope. They trade off levels, and right now, there are two zones that matter more than anything else. First, downside support, the $100 to $110 zone. This is the psychological and historical dip buying region, is where stackers step in, is where long-term bulls add to positions, is where physical buyers show up with cash. This zone has been tested multiple times over the past few weeks, and every time buyers have defended it. That doesn't mean it can't break. But it does mean that if you're looking for a lower risk entry, this is the zone you're watching. A clean break below $100 would signal that the bears are in full control and that we could see a deeper correction. But as long as this zone holds, the bull case stays intact. Second, upside resistance, the $120 to $125 band. This is where prior rallies stalled. This is where profit takers showed up. This is the ceiling that needs to break for silver to enter a new regime. A strong breakout above 125, backed by volume, backed by macro tailwinds, backed by sustained conviction, would shift the narrative from range-bound frustration to genuine trend reversal. That's the signal traders are waiting for. That's the confirmation that we're not just bouncing inside a range, but actually breaking out into new territory. Now, why do zones matter more than single prices? Because markets don't respect exact numbers. They respect regions of supply and demand. If you're sitting there staring at $105 as your perfect entry, and silver bottoms at 107, you miss the move. But if you're thinking in terms of the 100 to 110 zone, you have flexibility. You can scale in, you can average in, you can build a position without trying to nail the absolute low tick. Institutions trade this way. They don't try to catch falling knives. They don't try to pick tops. They wait for price to enter a zone, and then they execute. And the reason this works is because zones reflect where behavior changes, where sellers become exhausted, where buyers become aggressive, where the balance of power shifts. Silver has a nasty habit of false breaks and stop hunts. It'll break below support, trigger everyone's stop losses, and then reverse higher. Or it'll break above resistance, suck in the FOMO crowd, and then collapse back down. This is not random. This is how liquidity is engineered. The market hunts clusters of stop losses because that's where liquidity sits. And if you don't understand that, you're going to get chopped up over and over again. Patience is a competitive advantage in this game. The traders who survive aren't the ones who react fastest. They're the ones who wait for the right setup, who respect the zones, who manage risk, and who don't let emotion dictate their execution. Silver is testing that patience right now. The battlefield is defined. The zones are clear. Now it's about discipline. Part 6. The choice ahead, wrecked, ready or waiting. So here we are. Silver just went through a $10 intraday collapse. Retail got destroyed, smart money is accumulating, the zones are defined, and now you've got a choice to make. Path 1. Emotional reaction. You panic. You sell. You swear off silver forever. You tell yourself the market is rigged, that you'll never win, that it's all just manipulation. And maybe you're right to feel that way after getting burned. But if you quit now, if you capitulate at the bottom, you're locking in your losses, and worse, you're guaranteeing that you won't be positioned when the next move happens. Because it will happen. Markets are cyclical, volatility creates opportunity, and the people who survive the pain are the ones who capture the gain. Path 2. Structured intent. You take the lesson. You acknowledge what went wrong, over-leveraged, no stop-loss, emotional entry, FOMO, whatever it was, and you adjust. You build a plan, you define your risk, you decide whether you're a long-term stacker or a short-term trader, and you execute accordingly. You don't confuse your trading book with your long horizon allocation. You respect volatility, you trade the zones, and you show up prepared for the next phase, whatever that phase looks like. For the long-term stackers, the core risk is psychological. It's giving up on silver right before the fundamental story matures. The industrial demand isn't going away. The supply deficit isn't going away. China's export restrictions aren't going away. The green energy transition isn't going away. All of that is still intact. So if you believe in the thesis, if you believe in the structure, then your strategy is simple. Dollar cost average into physical positions, ignore the daily noise, and let time do the work. For the active traders, the risk is different. It's getting chopped to pieces in a headline-driven sideways market. Silver whips around economic data, Fed meetings, dollar moves, equity volatility. If you're over-leveraged, if you're trading without hard stop losses, you're going to bleed out. The smarter play is to respect the volatility, define your risk per trade, and trade from zone to zone. Don't try to predict the macro turning point. Just trade what's in front of you. Let's zoom out for a second, because silver is more than just a ticker. It's a mirror of the global system. It reflects monetary fear, the distrust in fiat currencies, the fear of inflation, the desire for hard assets. It reflects industrial growth, the build-out of renewable energy, the electrification of transportation, the expansion of digital infrastructure. And it reflects social distrust, the belief that the system is rigged, that institutions are corrupt, that individuals need to protect themselves. All of that converges in silver, and that's why the volatility is so extreme, because the forces pulling on it are so powerful and so contradictory. Here's the final humanitarian framing. Markets punish ignorance, not morality. If you got wrecked on January 29th, it's not because you're a bad person. It's not because you deserve to suffer. It's because you were unprepared for a system that doesn't forgive mistakes. And the way forward isn't to rage against the system. It's to understand the system, to adapt to the system, and to position yourself intelligently within the system. This was not the end of silver's story. It was a test, a stress test of conviction, of preparation, of emotional discipline. And the people who pass that test are the ones who are going to be positioned for what comes next. So here's the central question, the one that matters more than anything else. When the next move comes, and it will come, will you be positioned, or will you be emotional? Will you be ready, or will you be wrecked? Will you be strategic, or will you be reactive? Because silver doesn't care about your answer. The market doesn't wait for you to be ready. It moves when it moves. And the only question that matters is whether you'll be there when it does.